Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Peter Berezin, Director of Research and Chief Global Strategist at BCA Research, to discuss implications of our current fiscal policy and the path for inflation. Peter, it's great to have you with us. Welcome to Trade Talks.
Thank you.
And Peter, excessively loose fiscal policy is not as much a near-term issue, but it can eventually lead to inflation further down the road. What would some of the market implications of this be?
Well, I think right now it's still too early to talk about a sustained increase in inflation. Employment in the US is still down about 5% from where it was prior to the pandemic. Now, it's true that many firms are reporting difficulty in finding workers, but we know why that is. Basically, what's happening is that unemployment benefits are extremely generous. So a lot of workers who might otherwise be employed or not seeking employment, and also the schools are still largely closed, and so that's keeping a lot of parents from working. These are temporary factors. They'll go away in September once the enhanced unemployment benefits and schools are open again. So I think inflation is a longer term risk. It's not a near-term concern. I would be much more worried about inflation getting to uncomfortably high levels in, say, 2 to 3 years rather than over the next few months. Right now, I think it really is a story about transitory inflation.
So, Peter, with this backdrop, what are you thinking in terms of equity sector and regional allocation, including U.S. versus non-U.S.? And of course, we're talking about themes such as value versus growth and small versus large. There's a number of things at play. So how are you thinking about positioning?
Well, global growth momentum is currently rotating from the US to the rest of the world. So that most likely means that stock markets outside the US will do well. The US dollar will probably weaken as growth picks up elsewhere. Historically, stock markets outside the US have done better in a weak dollar environment. I would also add that value stocks have also generally done better in an environment in which a dollar is weakening. So if you think back to the late 1990s, the dollar was strengthening then, growth was clobbering value. And then when the dollar peaked in 2001 and began to weaken, value started to catch up. So as long as we remain in this weak dollar environment, I think value is the place to be. The end of the pandemic is good for value. Value was hurt by the lockdowns. Tech benefited from the lockdowns. But the pandemic was last year's story. This year's story is about reopening.
And stocks have been especially sensitive, particularly the tech sector, in terms of what's happening with the 10-year. What are your thoughts around what we're seeing in bond yields, and of course with that backdrop of longer-term inflation?
I don't think yields are going to rise a lot for the next year or so. Directionally, they'll probably go up as the output gap is closed and growth remains above trend. But right now, I think some of the worries about the Fed turning hawkish are excessive. In fact, we're already starting to see some input prices come down. Lumber prices are down over the last couple of weeks. Steel prices are down. Agricultural prices are down. Memory prices, of course, we're worried so much about the semiconductor shortage. But memory prices have actually been falling for close to a couple of months now. So as long as this inflation scare really turns out to be transitory, the Fed's not going to raise rates anytime soon, and that will keep a lid on bond yields.
Right. So it seems as if most of the pressure is within the services sector. Just getting people back to work is really, where the sweet spot is to determine how this demand is going to be met.
That's right. That's right. So if we started to see price wage spiral emerge, where firms were really competing with one another for workers, bidding up wages, forcing them to raise prices in order to protect margins, leading to another round of wage hikes. Now, some stuff like that can happen. It certainly happened in the mid-1960s as inflation began to take off, but there's very little evidence for that in the data now. If you look at sort of clean measures of wage growth, such as the one produced by the Atlanta Fed, you don't really see much of a wage spiral. So this is a risk, but I don't see it as an imminent risk.
All right. And Peter, one more question as we're talking about wage growth here and this concept of transitory inflation. Should we see wage growth, that's if I understand it correctly, not so transitory because you can't retract wages once you've already put an increase in there. So won't that kind of always be with us?
I think right now we want to see higher wage growth. We've gone through the last 40 years where wages have failed to keep up with productivity growth. And so the share of income going to workers has contracted. So certainly some meaningful wage growth right now would be welcome. We don't want to see so much wage growth that inflation begins to rise to uncomfortably high levels. Right now, however, that's not something that we're seeing in the data.
All right, Peter, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.